Instead of having your sellers do a major price reduction, let's talk about the 2-1 buy down. Now, we talked about this the first time about 3 months ago or so, but it seems like people are just now catching up to this, and there's a lot of stuff on social media out there about the 2-1 buy down. So I want to make sure you understand it, understand how it works, and how it could benefit both your seller and the potential buyer of the house. So attached to this email, there is a 2-1 buy down flyer. It's just example numbers here, but let's walk through what it is and how it works. Now, let's zoom in here to the chart on the right center of this flyer and explain what this means. Here you're gonna see an example of $650,000 purchase price with 20% down. So we've got a $520,000 loan amount. Let's just say the rate today we're at 7% with no points. Again, just a sample here to make their numbers even and easy to understand. So the 2-1 buy down refers to in the first year, your interest rate is bought down by 2%. So in year one, you'll see on this chart, your effective rate is going to be 5% and your monthly payment is $2,791.47. That's a savings of $668.10 over what you would normally pay at that 7% rate. Now, year two is at a 6%. So year one, you'll see, was bought down by 2. Year two was bought down by 1%. So a 5% the first year, a 6% the second year. The second year saving you $341.91 there. And then here's the cool part. This is not an adjustable rate mortgage. This is a fixed rate, meaning in years 3 through 30, it's 7% and it remains at 7%. And that would be your normal payment. So 2-1 buy down. 2 refers to the first year, your interest rate is 2% less. 1 refers to the second year, your interest rate is 1% less. And years 3 through 30, your interest rate is just this fixed interest rate that you normally would have gotten. Now, this costs, and we'll go back to the chart here, $12,120.12, right? It's right there in the chart. So this costs a little over $12,000. So how do we get that $12,000? Where does it come from? Well, this is the cool part, right? Let's say a seller would reduce their price by $10,000. Well, you know what? Let's make it the $12,000 that this 2-1 buy down costs, so we're comparing apples to apples. A buyer in this example is gonna save with a $12,000 reduction in price about $70 to $80 per month. Not a huge amount. However, with the 2-1 buy down, if the seller were to fund that 2-1 buy down and pay for that 2-1 buy down, keep the same price, but pay for that 2-1 buy down, well, the first year it saves them almost $700. The second year, it saves that buyer almost $350 per month. So with the same $12,000, instead of taking a reduction and funding a 2-1 buy down instead, we're talking almost $700 a month for the first year, almost $350 a month in the second year, far greater than the price reduction of $12,000. And anybody who's been in this business for a while realizes rates are cyclical. They're gonna go up, they're gonna go back down. I can't tell you, I don't have a crystal ball as to when that's gonna happen. Well, if rates do end up dropping as predicted in the next 2 years, well, that's great. Now that buyer can now refinance their loan and get themselves into that new lower rate, maybe sometime in that 2-year period. But in the meantime, paying drastically less for that mortgage, paying a mortgage for the first year as if they had a 5% interest rate, and for that second year as if they had a 6% interest rate. So that's what you need to know about the 2-1 buy down. You're seeing a lot about it. You're wondering what it is. That's the skinny on the 2-1 buy down. If you've got questions, reach out to me. I'm here to help.